Good morning, everybody. Hope everybody has had a good morning so far. Good to see you guys. Good to see everybody. We'll give a little bit of time before we actually get started with all the show and stuff like we always do. This is kind of the part where we just kind of hang out for just a few minutes, let all the technology, kind of do its thing, sending out the feed and all that kind of stuff. So we'll settle in. So hopefully everybody had a good day yesterday. I was not able to live stream. I'll give you a little bit of insight on that. We had our end of season track party with our team and for track season. And it was actually my son's. I talked about this. It was his last season. He's graduated high school, going to college, that kind of stuff. So we got in really late. I mean, really, really late. So I did not get up early in time to do anything. It was like, I think we got in like at 1:30 or something ridiculous. Something like that. Or maybe I was in bed by that time. So my whole day was just kind of off because I'm normally an early riser. I'm like 5 a.m. That's my day. That's my time. I did not get to do that. So I was like off schedule. I kind of like all day yesterday. So I was like, you know what? I'm throwing out a little post. I'm not doing a live stream. Got to be able to do that. I'm not going to try to beat some kind of algorithm here or play any kind of game like that. I'm literally just doing this for fun. So if it doesn't work on my schedule, I just can't do it. But anyway, today, though, we're here. So that's awesome. This will be the last stream for this week. And then next week, I will aim to live stream Monday, Tuesday. I will not be streaming Wednesday on, and I will not have another stream for quite a while. I'll be off for a couple weeks, actually. So just to kind of give everybody a heads up, just so if you're interested and you want to know that, looks like I won't be back until possibly the 11th of June. So just FYI, this next week might be my last little bit of live streaming. Anyway, before we get started, I want to talk about just something real briefly. Yesterday I did have to travel. I left town and was gone, and then of course had to eat some dinner somewhere. So we ended up going to Blaze Pizza. If you've never been to Blaze Pizza, it's actually pretty good. It's kind of like a I don't know, like you had this rise of like the your typical Subway sandwich places. You go and get your meats, you choose your toppings, whatever, and then they make it for you. Same kind of thing with this Blaze Pizza. If you never had it, it's really good. So we went to Blaze Pizza to get some pizza. So for dinner. So while in there though, this is the part that has nothing to do with the show, but just kind of an insight for me. Is the staff. The staff there were like top-notch people. And I mean top-notch, not just because they were really good at their service. There was this camaraderie there where it was just evident that they cared for one another. I mean, if you were to just kind of step back and observe what was going on, they were laughing, they were cutting up, they were still doing their jobs, but everybody was happy to be there. And you saw one group kind of talking off to the side where they were, blazing the pizzas. They were just kind of talking and encouraging one another. At one point, they gave each other a side hug, and you had this other couple, there's a couple other ones goofing off in the back, and it was just vibrant. Just everybody looked like they were having fun. So then I progressed through the line. I got my pizza. My pizza is now in the oven, getting baked, whatever. And I'm standing back, and one of the guys is back there folding and building up the boxes that pizza's going on one of the tables. So he's behind me. So I'm just standing there, and he just kind of starts up a conversation with me. And he said, hey, somehow we got onto it. In the conversation, he said, tomorrow marks our 10th year anniversary here at this location. We're all very excited. And most of these people here have been here for a majority of those 10 years. And I was like, wow, that's kind of crazy. In the restaurant industry, it's a high turnover rate. And so I just kind of asked him, I said, why do you think that is? Because why? I mean, it's a restaurant business. Like why is it that there's, not a high turnover rate? And why is most people here? He said, the owners and the managers and myself, we really pay attention and care for the staff. And he's like, we make sure we understand their birthdays and anniversaries and things going on in their lives. We ask questions, we engage with them. He said, it's just a really family environment. He said, I'm not just saying it's a family environment by name only. It is by action and deed. And he said, and it's definitely that way. And he said he's been there for 9.5 years of those 10. And he took off a couple weeks ago for vacation, and everybody sent him text message, we miss you, whatever. And he said, he said, I enjoyed my vacation, but it's always good to get back. He said, it's such a fun environment to work in. So I was just observing this as I was going, and I was like, man, can you imagine having a workplace where it's work, but everybody desires to be there and everybody supports one another and there is that camaraderie there? And it's a hard thing to do because if you try to force that kind of behavior, then it becomes all fake. But if it's a true environment where the heart of the leader, the manager, and the staff are caring about one another, think about I as a customer, never been there before at all. Just look at the observation that I had in that one moment, right? Like at that one moment, I walked out of that place and he tapped me on my back. And he said, hey, have a good day. He said, happy 4th of July if I don't see you, that kind of stuff. Like, not in a town that I don't even live in, right? But it was this immediate, like, kind of like, yeah, I would absolutely come back here. I would have no problem coming back here. They care for one another. They care about the customer. They're engaging. They're smiling. They're laughing. Doesn't mean they don't have their bad days, but the environment was so healthy. And I just observed that. I was like, man, let us all just really try to, make that happen in the work environments we're in, even when there is obstacles and challenges. May that be our desire, because I think we would function better. Our clients would be served better. And look, restaurant industry, that's a tough industry, guys. And if they can do it, we absolutely can do it as real estate agents. We get to do a really fun job, really. It doesn't mean we be fake and think that everything's just always great. It's really just being real with those we work with and even our clients, and just being honest with them and kind of building that camaraderie. And it's a lot of work. But anyway, I left that with a great experience, thinking I would come back here. I would love to see that across many other real estate companies as well, that is the camaraderie there, like that people just support one another. I left there thinking, man, this is great. So it was just my observation. I truly enjoyed it. It was just to get a pizza. So it's pretty wild. Anyway, I want to start with that. Yeah, Michelle, you're right. Not all agents will do this, unfortunately. And that you're exactly right. Yeah, it's a great story. Thank you. Yeah. I do wish that would be the case, but you're right. Human nature kind of begins to take hold, and agents can kind of get cynical with one another, and you get in these tense situations and they hold grudges, and it creates a breakdown in the relationship. It really does. And it requires a strong maturity in the person to be able to have disagreements, civil discourse, all those type of things, to then, come humbly back together, reduce any kind of pride, and try to make things work. This is like the ideal world, right? It is difficult, and it's so hard to do. But I think that it comes down to good leadership. I think if the leaders really put forward a good effort that they care, they can foster that. But it also means that a good leader doesn't avoid confrontation when it's necessary, and addresses those things as soon as they arise. And that's another good sign of a leader, because it's very easy to just kind of skirt and put things under the rug and not address them and bring parties together, because it's okay. It's very easy to make things look great on the surface and then have this major bad undercurrent thing taking place that's not being addressed. And because people aren't confrontational. But a good leader is going to sit down and bring people together and talk through these type of things. And that is going to help kind of foster that same kind of environment. Because if you can go through that, then you're going to be able to hold each other more accountable, and you understand that everybody's kind of in this together and you're trying to work this out. But you're right. You definitely can't do that automatically, and agents can be very difficult. If I would just say, I think if all of us spent more time focusing not on situations and just on the bigger picture, I think it would help. I think we get so pigeonholed into the idea of this is so bad, this is so wrong, I can't believe this is happening, that we lose sight of the bigger picture about what's really going on sometimes. And we form opinions and judgment on somebody else that maybe we're just as guilty of. And that's something we just got to be careful of as well. So anyway, not really the topic for today, but it was a good experience. All right. With all that being said, let me give you an idea about what we're going to be talking about today, because it's going to be different today. It's going to be different. Praise the Lord. Because here in the past few weeks, you know what we've been talking about, this whole Zillow, Compass, all this kind of stuff. I'm not talking about that today. I'm not. I told everybody, I think Monday, I said, I'm going to talk about Federal Reserve, how that correlates and what the economy and how they adjust the economy and that breakdown and all that and what that looks like. So today this is going to be more of an educational type live stream. Throughout my years in real estate, the typical thing we hear is like, oh, Fed cuts rate, and then we start talking about mortgage rates. And then there's this disconnect in understanding like how the Federal Reserve affects the economy and how that Federal Reserve rate affects mortgage rates. So today I went ahead this morning, spent a little bit more time going through and just finding some articles, some information, that kind of stuff, so we can have a discussion and give a strong foundation here on what the Fed rate and the Federal Reserve is, how it operates. Then we'll get into the nuances of how that kind of correlates inside of the real estate industry. This is one of those kind of topics, like if you go to real estate school, it's like they don't describe these type of things. They don't talk about this. And then we don't really fully understand how this all works in intricate details. But when we take a step back and we understand how the Federal Reserve works and what their main role is, when we hear the terms, it helps us to better understand the articles and the news that we're reading to be able to help our clients better, because we can see a much broader picture. Bobby, good morning to you, my friend. Hopefully your training is still going well. Let me know what you're training for, man. I know you're always in a triathlon of some kind. So I'd be curious to know if I think you're probably still training for one. But yeah, let me know, man. Good to have you here. We're going to be talking probably a long time kind of about that. And then if we have time, we'll go into some other topics. I'm not going to rush the Fed Reserve. It might be a little bit boring, to be honest, but I think it's very important information to kind of break this all down. And we might even repeat ourselves a couple times in these scenarios because some of these articles overlap one another. But just to kind of give you an idea how that's going to happen is, like, I've got a article from the CFI, which is a banking institution. Then I've got an article from Inman describing it. But then I'm going to jump to, and this is the weird leap. It's a website called physiciansidegigs.com. Okay, that seems like a really weird transition, but the article is really good because it's basically trying to educate physicians on the housing affordability, Fed rate, on as far as investing goes. Basically, if physicians are making a lot of money, where should they put their money and how does that work? And this is an article kind of talking about that. So I was like, this is a really good comparison to see how it goes across all different perspectives here. So we'll do that. Then if like I said, if we have time, I'm not going to labor too long here. Okay. Hey, here we go, Bobby. Yeah. Let's see. I just registered for my exams and getting married tomorrow. Dude, that's awesome. Congratulations on the marriage, man. That is so cool. Let's go, buddy. Congratulations on that. That's a great moment, man. Great moment. And and register for your exams as well. Dude, you're having a week. So man, I'll be praying for you, man, for that exam. It can be a lot of pressure, but man, you got this, bro. You got this. And then the next try is in a couple months away. All right, so 2 more months. So when do you begin and forgive me, I'm marathon, top runner, half marathon, that kind of stuff. So we do what's called a taper. So we'll do the tapering. So I'm just kind of curious, do you taper in a triathlon training? I would assume you're tapering some, but man, when you have a try sport, I don't know how that would actually work. I've never done it. So I'm just kind of curious, but man, cool. What a week, dude. What a week. That's awesome. Congratulations, my friend. So, I'll talk a little bit about inventory, and what that looks like, rising, falling, that kind of stuff, if we have time. And yeah, I don't know if we'll get, I'm already reaching, to be honest. From data to decisions, what sellers need in today's market. We might have a conversation about that as well. Kevin, good morning to you as well from Lakeland, Florida, buddy. Good to have you. You are another fan that comes in almost every morning. Appreciate it, my friend. Good to see you. And then you have realtor.com. I've got an article that says, know the neighborhood, not just the numbers, why community expertise wins. I just put those in. These are layovers from the couple streams ago that I still find very interesting. I just not have covered. I'm leaving them in. We'll see if we get to them or not. I'm really focusing in on the Fed rate and Federal Reserve today. So we'll see what happens. All right. With all that being said, man, we have set the groundwork. I appreciate everybody here and commenting. I love it. I love that engagement. That's the community I'm looking to build. I think it's fun. And and Bobby, thank you for sharing, life stories, that kind of stuff. I think that's what creates a community. We're really leaning into learning about each other, helping each other. I love that. I really appreciate that. All right. Let's go ahead and get started with the show today, guys. Welcome to the Real Estate Brief. I'm Adam. Today, we're going to be cutting through the noise. We're going to get to the truth in the news. We're going to look at the data, and I'm going to give you some of my observations and where I believe you can find opportunity. So if you're ready to gain your real estate edge, let's dive into our first story, or kind of our first topic, educational moment, whatever you want to talk about it. That's what we're going to be talking about today. So today, we're going to start off with talking about the Federal Reserve. We're going to work on towards demystifying the Fed hype and what that really looks like versus the reality in real estate and how it correlates with the mortgage rates, and try to bring a much broader understanding to the entire process on how the Federal Reserve brings balance to the economy. And then that trickles down into all the other types of industries. So we're going to be talking about that. And I will pause for just a second in that whole introduction to recognize Bobby here. Always taper and carb load before a race. Yeah, okay. I figured you probably tapered. To be honest, I figured you probably did. I just didn't know how that actually worked as far as running, swimming, and biking. Like, I that's more of my, just my own idea. Because just to be honest, a triathlon has always interested me. I'd like to do it, but I'm going to suck really bad at the swimming part of it. Like, I'm not I can swim. I just don't think I can swim for that long, that far. So well done if you can, man. That's crazy good. All right. Back to the topic, guys. So the reason why I'm really wanting to hone in on this is we read headlines all the time that scream to us that, the Federal Reserve is cutting rates or hiking or slashing or, whatever adjective you want to use to describe what's going on there. And every time that kind of ad or that headline runs, it's always like it sends some kind of shockwave through all the news media sources. And, they either panic or they accelerate or they, misconstrue what that actually means. So today, the goal is really to kind of cut through that kind of noise and kind of really look into the depths of what the Fed actually is and how they control things and how that impacts the true bond market, right? Because that's ultimately what we're talking about here. And then that will help us to better understand what that means for everyday real estate operations and transactions, mortgage rates and banks and how they exchange money and all that kind of stuff. So if you guys are ready for this conversation, we will go ahead and jump into this after a quick swig of coffee. All right. So this is an article that I'm going to start off with by the Corporate Finance Institute, CFI. All right. So this is by the U.S. Central Bank, and they're talking about what the Federal Reserve, the Fed, is. And I want to start off with talking about how the Federal Reserve came to be, what its main purpose is, and give an idea and a more broad perspective about what the Federal Reserve is. And if you know about this and you know how this works, great. If you have input or corrections or anything like that I might misspeak, great. This is live, so I might get some confusion here. But if you have understanding about this, feel free to share that as well, or your own observations and experience with the Federal Reserve, okay? All right. The Federal Reserve, more commonly referred to as the Fed, okay? It's the central bank of the United States of America. That's the first premise about what it is. It is the central bank, okay? Just think of the U.S. has a bank, okay? This is it. All right. It is the supreme financial authority behind the world's largest free market economy. Because of the magnitude of the U.S. influence on the global economy, the Fed is considered one of the most influential financial institutions in the world. Okay. So you got to understand this. The first thing we want to kind of just observe is the power that the Fed actually has over the global economical scale of many industries across the world, around the world. So when we start talking about imports, export, what that might look like, the Fed here, this free open market economy is adjusted by the Fed that trickles out all around the world. Okay, so it's a big, powerful entity when it comes to describing the economy. Sorry, I had a little notification pop up. All right, the Federal Reserve handles the monetary policies of the government independently and without legislative intervention. Okay, so this is another key thing. They handle it. They handle all monetary policies, everything outside. They don't have legislative intervention at all. Okay, so it's like a separate entity. In addition to that, it performs all other functions of a central bank, regulating bank activities, conducting surveys about the U.S. and global economy, all under the common objective of maintaining financial stability. Their sole premise is observing, reading, digesting, discussing, and talking about what is going on in the financial world, specifically in the U.S., but it trickles out. That's what they're getting together and talking about. The Federal Reserve is headquartered in Washington, D.C. You guys can walk by that building. We actually got to do that when we were in Washington, D.C. a couple years ago. Okay, so it's in Washington, D.C. That's where they have their annual meetings. That's where everything takes place. It all happens there. Now, let's talk about the history of the Fed. Who is the Fed? How did they get started? What does this look like? The Fed was born indirectly out of the panic of 1907 and the overall economic situation during that time. The last quarter of the 19th century and the beginning of the 20th century were characterized by recessions in the U.S. economy, right? If you go back and you research this history, most of you guys went through this in history class and U.S. history classes. You understand what we were going through back in 1910, 1913, right? And all the way up to like 1920. You guys understand the makeup there, so we won't spend too much time there. A series of financial panics forced eminent bankers, okay, these are the big dominant bankers at the time. So we're talking about J.P. Morgan, John D. Rockefeller Jr., to call for a new central banking system, okay? In other words, you had all these private banks kind of operating the way they wanted to, but everybody can kind of do it the way they wanted to. So it was not centralized. It was not regulated. It was just the Wild West in some ways, right? So these big bankers, these eminent, prominent bankers decided we need some kind of central banking system to bring stability to this market. Mind you, keep in mind that they own banks, right? They are bankers. And if you have this uncertainty in the market where there's all this undue pressure, Great Depression, all this kind of stuff's looming, all this kind of stuff's happening, you can understand the fear that these guys had. It's like, man, if we don't do something here on a federal level, then this whole fictitious system could come crumbling down and cease to exist. And then we have a much bigger problem. So kudos to them for thinking forward and being like, look, we really need to be figuring out something, okay? Now, you might disagree with some of their policies and the way this kind of came about and kind of what else these guys stood for or whatever. But when it comes to actually talking about having a central banking system, in a lot of ways, it was the answer. And it has been a very interesting, experiment that has had many successes. There's been failures, but a lot of successes because of this that a lot of people around the world have emulated. So let's just keep all this in mind. The country's dire financial situation then prompted Republican Senator Nelson Aldrich to set up two separate commissions to study the American monetary system and the European central banking institutions. Okay, so he basically knew they needed to do some research before they just decided to do something. So they began to form these committees to go out and research and find out what's going on and find out what other banks and other places are doing. Aldrich was highly influenced by the model of the Bank of England and the German monetary system. Although his initial proposals were repeatedly rejected by Congress, a reformatted bill was finally passed on December 22nd, 1913. Functions of the Federal Reserve. So here's what the Federal Reserve does, and we'll get into more nuances of this. The Federal Reserve is a central bank of the United States and thus is responsible for maintaining the overall stability of the country's economy. Okay, so when you just dumb it down to its simple definition, what is its role? It's responsible for maintaining the overall stability of the country's economy. So when you start talking about Fed rate, understand that they are not doing that just based on what's going on in the real estate sector. They're looking at all economies across the country to decide on what's actually happening to be able to come up with what that rate looks like. And we'll get into what that treasury yield and all that kind of stuff looks like. Conducting monetary policy. The Federal Reserve, through its monetary policy, strives to achieve three major objectives as laid down by Congress. So here's the three objectives that they adhere to even to this day. maximum employment. So they're looking at that employment rate, seeing what's happening there. People losing jobs, gaining jobs. Is income going up? Is it going down? Okay. Stable prices. What's going on in the market in regards to many things like GDP? What's the import export look like? What's going on there? And low long-term interest rates. So what's happening there? What's the payback look like? Are people affording this based on the employment and the incomes and all that kind of stuff? They're looking at all these numbers. The Federal Reserve controls inflation, investment, and other economic parameters by controlling the availability of credit in the economy. Okay? They promote financial system stability. The Federal Reserve ensures the stability of the U.S. financial system, monitoring internal and external influences and preventing any future crisis. They also regulate financial institutions and their activities. Okay, so they're doing a lot of regulating of all banks in the industry that based on the Federal Reserve, okay? So it says supervises the activities of financial institutions and controls their impact on the economy as a whole. We're getting down into the nuances here on how this might trickle down into what the banks do and how they charge interest rates and that kind of stuff. They're fostering the payment and settlement system safety. The Federal Reserve works to ensure a glitch-free, secure system for payment gateways for the benefit of the American citizens. How do we exchange money? What does that look like? And promoting consumer protection. Consumer rights are an integral component of the financial services sector, and the Federal Reserve works continuously to ensure these rights for all consumers. So they are also the oversight committee for all banks. They are monitoring to make sure that there's not unscrupulous stuff going on inside of banks in regards to loans and their customers, okay? So they're also the lobbying body behind that as well. The structure of the Fed. This is giving you a good overview. That's why I picked this one. It's like this is a very good foundational understanding about the Fed and how this works. The Federal Reserve Central Bank is a multi-layered financial body, deriving its authority and spirit from the Federal Reserve Law of 1913. Now, some things have changed, but a lot of it's still kind of in play too. And if you it's a boring read, but you can go back and read that. Read the Law of 1913 about the Federal Reserve. You might be real estate agents. You might think, I'm not a banker, but look, this is very good stuff to know. Despite being executive agency, the financial body is largely independent of the control of the president or Congress. That's a key thing, guys. They can't have undue pressure from the president or Congress on the way that they operate, and is described as being independent within the government. The Federal Reserve's four main axes of power include the following. Okay, so you have the Board of Governors. So there's a Board of Governors over the Federal Reserve. You have the Federal Open Market Committee. So then you have a committee based upon what is going on in the open market in regards to the economy, exchanging of money, that kind of stuff. Then you have 12 regional Federal Reserve banks scattered around, okay? And then you have other members of banks. So this is the structure of what the Fed looks like. The Board of Governors of the Central Bank, here's what they are. This is how this operates. It says a 7-member Board of Governors oversees the overall responsibilities of the monetary body as a central bank, managing the activities of 12 regional banks. So you have this bigger conglomerate of governors governing those 12 other entities, okay? They frame the monetary policy and supervising the economy in general. Each member of the board is appointed by the president for 14-year terms. So that's the only pressure that these are going to get from the president. But it's 14-year terms. So you think about that, how that's spread out over multiple different presidents, right? And when someone expires and someone comes on, there's a reason behind that. It's logical. If you have 14 years, it's going to take a lot more time for one president to do any kind of influencing, right? If they serve 2 4-year terms, that's 8. So that one person might only replace 1 or 2 of those governing bodies, whereas another person's elected, and it gives a little bit of a buffer there. So it's all by design. While the chair and the vice chair are appointed by the board for 4-year terms, at present, 3 of the 7 places on the board are vacant. Federal Open Market Committee. The Federal Open Market Committee is the committee in charge of handling open market operations, which is an important component of monetary policy. It is a 12-member committee consisting of all 7 members of the Board of Governors, so all of them are on there plus the additional, and the presidents of any 5 of the regional banks. The representatives of the regional banks are chosen for 2 to 3-year terms, while the president of the Federal Reserve Bank of New York is a permanent member. So there's one permanent member. Regional Federal Reserve Banks. The regional Federal Reserve Banks, 12 in number, are tasked with carrying out the monetary policies as prescribed by the board. A 9-member board sits on each bank. So again, not one person, even though you have one person on that as a member of that committee, they are also in charge of a board that then discusses and brings back. So again, not one person can just make all this unilateral decisions and maintain control. So you can kind of see the strategic balancing of what's going on here. Each of these banks carries on its own operations besides its regulatory role, holding securities and giving out loans. Other member banks. A member bank is a private financial institution that owns stock in its regional Federal Reserve Bank, earning profits from the stock. So they're buying and investing into the regional bank, into the reserve bank, and they are the bank themselves that is investing in this reserve, okay? From the profit that the stock earns, the banks receive a 6% dividend, while the rest of the profit goes to the U.S. Treasury. Now, there's multiple other readings there, but we'll stop there on this article. You get the idea. This gives you a great foundation on just the idea and the structure of the Federal Reserve, okay? So now we built the case. We kind of got a better understanding about how that's governed, how it's organized, that kind of stuff. So now let's begin the conversation in regards to how it operates. Give me a thumbs up or a like if this is making sense, if you're following. If you have any questions, stop me, ask. That's all perfectly fine, guys. Excuse me. All right, let's go ahead and jump into the next article here. And I'll be going kind of back and forth on this one, I believe. I think that's how I got this kind of structured. This next one here, all right, awesome, Michelle. Thank you so much. Appreciate that. This next article is by Inman. So this is very specific to the real estate industry, but it's going to help us. And I'm going to go from this article to another and kind of back and forth a little bit here. It says, what is the Federal Reserve and how does it impact real estate? Okay, so this is going to be a very honed in, and then we're going to jump over to another article to kind of broaden the scope just a little bit. Improve your understanding of how broad economic factors impact the housing market. All right, the Federal Reserve, also known as the Fed, is the United States central bank. So this is going to be a little bit redundant, but we're going to tie this all in together. And one of the key drivers of mortgage rates. Okay, it's one of the key drivers. So we're going to establish up front, now we're getting into the real estate area just a little bit, that it is one of the driving forces of the mortgage rates. And we'll make sense of this. Because mortgage rates contribute to housing affordability, housing supply, and the overall economy, the Fed's policies and actions can strongly influence the real estate market. So if we go back to what we were just talking about, what is it that the Fed is monitoring and looking at to determine what to do with the Fed exchange rate? Well, they're looking at market economic data. And what is it about the industry, in our industry, housing industry, that they look at? Well, the affordability is one. Housing supply is another. And then they compare that to the overall economy and what's going on. And that's where you get to if you really dumb this down, supply and demand. Okay, so that's where this goes. And I recommend this book all the time. And I still recommend this book. This is the book, How an Economy Grows and Why It Crashes, Peter Schiff. It is a very simple read. It's nothing complicated. Matter of fact, look, see, like it's even got little cartoon characters in it. I recommend this book. It's super quick read, but it goes down to the very basics of the economy. It starts off very simple, and then it scales up from there, and you get a better, broader perspective on the economy and how they're trying to adjust this type of thing. It even introduces the Fed into this. So I highly recommend just kind of reading this as a good foundation if you find yourself kind of confusing about supply and demand and how the economy actually rises and falls. And it'll help you kind of understand this even better, but in a more simple way. As a matter of fact, I've even read this to my kids. And see, people actually asked me if that was a real bookcase behind me or is a graphic. So there you go. It's actually my books. All right. Here's a rundown on how the Federal Reserve impacts real estate. It says how the Federal Reserve impacts real estate. What is the purpose of the Federal Reserve? What is the purpose? We kind of discussed this. The main purpose of the Federal Reserve is to keep the U.S. economy healthy and stable by focusing on two goals: maximum employment and stable prices. Together, these two goals are referred to as the Fed's dual mandate. Okay? All these articles are in my YouTube description. You guys can go back and read through these if I get through it too fast. And they have other links inside of it. Like you'll see dual mandate. You can click on that and get an understanding about what that is and so forth. So if you really want to go into the rabbit hole a little bit more and get a broader understanding, you can do that. There's many more links here. Obviously, for time's sake, I'm not going to do that today. To achieve its dual mandate, the Fed oversees U.S. monetary policy using tools that include setting interest rates paid to commercial banks for their reserves on deposit and buying and selling securities on the open market. I'm going to break that down. By using tools like these, the Fed tries to strike the ideal balance between keeping inflation at bay. 2% is the Fed's typical target. We talk about that all the time. They try to keep it at about 2% of inflation every single time. That is the goal. And promoting the highest level of sustainable employment. Okay, so that's the mandate. Jumping over to another article here. This is where we're going to talk about that process and kind of a little bit more of a broader perspective about how they set the rate and what this looks like. All right, and then we'll come back to that article I was just on it with Inman. And this is a little bit of a bunny trail, but not really. I think this article just did a great job explaining how the Fed actually sets these rates and helps us to understand it on more of just a more economical scale and not just about real estate. That other article is going to go more specifically into real estate. This one's going to talk about it more for just everyday operation, where from car loans to interest rates to exchange rates to investments to real estate, you name it. It's going to cover kind of all of that. So now let's jump into this. I have no idea what that means. Yo, Adam, give me the Zuck. I don't know what that is. All right. What do interest rates, and maybe I'm just not understanding that. Sorry. Sorry, Lynn. All right. What do interest rate cuts mean for physicians? Or we could just simply say the general, person out there, right? This is just a website aimed at physicians. After a few years of the highest interest rates, thanks for the follows, Safalamri. Thank you for the follow. Appreciate that greatly. Thank you. After a few years of some of the highest interest rates and inflation in the past decade, the Federal Reserve is starting to cut interest rates. We kind of saw a little bit of this going on. Depending on your stage in life, this will have different effects on you as a physician or anybody for that matter. Those that have a lot of debt, like mortgages or student loans that are at higher interest rates, may be excited about the idea, blah, blah, blah. This is not what I was wanting to start at. Right down here. Okay. 10 areas impacted by Fed rate changes. Okay. So when the Fed, we always think of it like, oh, Fed rate changes and then it's just going to help real estate. The Fed rate affects many industries and not always even affects the mortgage rate sometimes. Sometimes it does, sometimes it doesn't. But here are the 10 areas that are impacted by that. Housing market, student loans and refinancing, CDs and other short-term investments, real estate investing, auto loans, home mortgage and refinancing, savings accounts, stock market investments, commercial loans, personal loans, and locks, and credit card debt. Okay, so those are the 10 areas. And if you really think about it, if we go back to understanding the foundation of the Fed and the Federal Reserve and what they're doing, well, those are the metrics. Those are the data points. All those different investment opportunities there is what they're monitoring. They're monitoring the data in regards to these things. And they're monitoring for job employment, income, affordability, and all that kind of stuff, and marrying the two together. Okay, so when you look at the complexity of this and you begin to dumb it down just a little bit, you understand that when they adjust a certain rate up or down, it determines what happens with these loan programs. So it then determines how much people are more free with giving their cash because the rates are lower. So they're pouring more money into the economy versus when the rate goes up, they're not pouring in as much money into the economy. So they're saving more. They're being reserved, right? They're not investing as much anymore, right? And you can see how that brings balance back to the market. But when they do things, when they adjust the Fed rate, it affects all 10 of those areas. I guarantee you, everybody on this stream right now or watching this later is going to say, well, I'm involved in 4 or 5 of those out of that 10. Okay. You might be involved in all 10 of those. So the more that Fed adjusts that, the more it affects you as a person. So there's your 10 areas. What is the Federal Reserve rate, funds rate, and how does it affect interest rates? Okay. So this is a good conversation. You have definitely heard about interest rates, but you may not have heard of the term federal funds rate. The federal funds rate is the actual target interest rate range set by the Federal Reserve, or more specifically, the Federal Open Market Committee. Okay, we talked about all this. Of it, that dictates the rate at which banks and some other institutions lend to each other. Okay? So it's if I'm a bank and I need to lend money, what's the rate that I can charge back on that money? Okay? So they're setting that exchange rate between banks. It essentially sets what these institutions charge each other for short-term loans. In case you're wondering, this is the part why I like this article. In case you're wondering why they're loaning each other money, here's the answer. Banks are required by law to maintain a certain percentage of their deposit balances in an account at a Federal Reserve Bank, one of those 12. So they often lend excess money in their reserves to each other. Okay, so I've got this reserve money, I can just sit on it, or if another bank needs money to have a much larger pool of money to be able to, invest and pour more money into the market, offer more loans, I, as a bank that had this extra money, can loan that money at an interest rate that is set by the Federal Reserve. Okay, so what does that mean? If you really just dumb this down, it's like if I have excess money and the interest rate of that goes down, I can then loan that money more freely. That bank will then be more willing to loan more money at an interest rate that typically could be lower, right? Because what they're being charged for the interest of that borrowing of that money is now lower. So what does that do to the mortgage rate? You see it, right? It begins to lower the rate. So that bank now has access to money that costs them less. They can then offer it to you for less. So when that ends up happening more and banks feel more comfortable with borrowing more money from other banks, they get more larger money, they then pour it back into the economy. As that rate goes up, they're not borrowing as much money from the other banks. Interest rates goes up because the risk is higher for them to loan more money out. Less people are buying. So that's the balance. And that's dumbing it down to very simple terms, but you begin to see how the flow of money is dictated by what the Fed is charging. So, and that's also why sometimes the Fed could make an adjustment and it not change the banking industry. Like if supply and demand of homes is strong, well, just because you lower the Fed rate doesn't mean the interest rate's going to go down because banks are comfortable where it's at, even though the Fed is kind of messing around with the numbers. Sometimes banks are like, well, the market's still good in the real estate sector. We're going to keep it where it is, right? Let me know if that makes sense. And let me know if this is bringing some kind of clarity that you've never had before as far as the way these numbers kind of operate, right? This rate is a huge deal because it significantly impacts the rest of the economy as it serves as a benchmark for interest rates elsewhere, including mortgages, student loans, car loans, credit cards, saving accounts, commercial loans, personal loans, bank loans, right? This in turn affects the financial and stock markets, corporate investment, foreign exchange rates, and personal and business decisions. That's why that Fed rate affects everything, because the exchange rate between banks to be able to free up money into the economy is dictated by the charge that they're allowed to charge for that interest, but to do so. I mean, when you take a step back and you like think about what was developed back in 1913 or began in 1907, 1908, and the complexities of this on how, now we think of just data as easy to get. Like I can go on to Google right now and type in anything and get endless amounts of data. Do you see how hard that would have been back then to understand all that kind of stuff? The amount of paper they had to go through, like computers, guys, didn't exist. So they had to go through and figure this kind of stuff out. So this was like, grassroots, hard work, going into the weeds, getting into the numbers, looking at actual papers and data and that kind of stuff to come up with this complex system that we are still using today. I mean, it's fascinating to me that it's still working, right? It's still working. It's amazing. All right, next question that would obviously lead to, and this is again why this article is great. It leads to the next question. When does the Fed increase and decrease interest rates, right? What causes that? 8 times a year, the Fed meets to discuss what it should be set at based on what they're seeing in the economy and how they want to support it by promoting economic growth. On 9/18/2024, this is just a scenario. This is going back in time just a little bit. The Fed cut the fund rates by 50 basis points to a range of 4.75 to 5. This was the first rate cut in over 4 years because of widespread inflation after pandemic. You may recall that when the pandemic hit, the Fed had responded dramatically, slashing interest rates to 0 or 0.25 in an effort to keep money circulating in the economy. So that's what led to this crazy inflation. The amount of money that was required by the banks to borrow money to then offer more loans drastically dropped. So what the bank had to pay back was barely nothing. So that would correlate to then why they wouldn't charge as a high of an interest rate. The market to avoid any kind of crash where people were scared and the panic was real in this pandemic and all this kind of stuff, they opened up the market to pour money back into it. I mean, think about it. We had checks being mailed to us for money, basically just giving us cash to keep us pouring back into the market. So all this money was freed up by these banks, and the way that in the exchange rate between banks and borrowing became so cheap that they could offer so many loans at a low interest rate because of this pandemic. And this is like when you hear me say in this show all the time is like, guys, we're probably never going to see this again in our lifetime, is because it is such a unique moment in time. It required a worldwide pandemic for this to actually take place. It doesn't mean it will never happen, but it's extremely, extremely unlikely that we will ever see that low of an exchange rate by the feds again. So that will always keep the rates higher. So when we start talking about the fear of the market, you start reading these articles like, oh, we're going up in interest rates, all this kind of stuff. This is why I constantly say this is a historical norm. Like, it's what it is. Outside of some kind of weird, crazy worldwide experience, you're not going to see that again. Like, this is where we're at. So this is helping you guys kind of understand, like, when we start saying like, oh, we're at 6.6 or 6.7 or whatever the interest rate might be, it's not a bad rate. It's actually what's everybody's kind of making money, and it adds stability to the market. It brings stability to the market. So there's not a panic. There's not an overconfidence. It's just a balanced market. So the Fed's doing a good job as far as trying to manage that inflation. Because if they didn't do that, we would just be inflating all the time, and that disparaging for affordability and income and employment would just be so far, that gap would be so wide that nobody would be able to buy a house. And we're still kind of there. Like, if you really kind of look at it, if you say like the average American that's earning $50,000 a year, they can only afford about 20%, maybe even less, of the homes that are currently on the market. That's affordability gap, right? So really you need $75,000 to $90,000 a year to be able to get into the 30-40% of the affordability gap to be able to buy the house that's on the market. So that's a much broader affordability gap than we've had my entire career in real estate. So they got to bring that down. So that's why these interest rates are not coming down that low. They're trying to hedge the inflation. So anyway, oops, sorry, I already shared my screen. Although this is a somewhat complicated and subjective concept, there are basic principles that dictate increases or decreases in the federal funds rate. The Fed will generally lower the rate when they need to stimulate the economy and promote economic growth, or to prevent increases in unemployment. What this does is to make borrowing cheaper, which then allows businesses to grow faster and spend more, right? It's cheaper to borrow money because they don't have to worry as much about paying high interest on their debt. Okay, very simple supply and demand situation here. The Fed will generally increase the rate if it's felt the economy is overly hot or if inflation is increasing too quickly. By making it harder to borrow money, it encourages businesses and people to be better savers and not spend irresponsibly. The Fed can also elect not to change rates at all when it meets, and often does if things feel stable. And this is what we're seeing. We're seeing if there's any kind of adjustment, it's micro. And it's because they're trying to hone in on that 2% inflation metric. That is their goal. They want a 2% inflation month over month. That is what they're wanting to see. So when they meet and they discuss these type of things across all industries, that's what they're looking for. And if that goes up, they begin to increase that rate. If it goes down, they decrease that rate. That's that supply and demand. Target interest rates range set by the Federal Reserve that dictates the rate at which banks lend to each other. When they go down, lowers rate. When they need to stimulate the economy and promote growth, makes borrowing cheaper. Let me just share this graphic, even with those on TikTok here. Okay, this is just a quick way for you guys to see this. When they lower the rate, they need to stimulate the economy and promote growth. Makes borrowing cheaper. Raises the rate if the economy is too hot or inflation is increasing too quickly. incentivizes saving versus borrowing. It's a very simple supply and demand thing, right? Leaves rate equal. Nothing changes, right? When needs are met and economy is stable, maintains the status quo. If there is not a drastic thing going on inside of the market across the board, they are more apt to then just leave it the way it is. That's where they're going to land. So simple supply and demand. I mean, that's really what we're looking at here, right? The amount that the Fed chooses to change interest rates by will reflect how urgent the Fed feels it needs to intervene. While most of the time, it elects to change the interest rate by 0.25, or what they call basis points, 25 basis points, right? You'll hear that in the news all the time. Hey, the Fed changed it by 25 basis points. Sometimes it will make larger shifts of 0.5 or 50 basis points or more. All right, we'll jump back now to this one here. We're going to skip on down. Though the Fed doesn't control interest rates directly, banks are generally free to set their own rates. Generally free. There's a little bit of regulation there, but they're generally free to kind of set those rates. And this is where the free market comes into play. And this is why you'll hear even agents talk about with their clients is you shop around. Okay, you go around and you shop at other banks and you talk to other lenders and you find out what the best deal is. Is because in some ways you can get confused and think, well, the Fed sets the rate and it's just going to be the same across the board. No, that's not true. Different banks are healthier than other banks. Different banks have different programs than other banks. Different boards get together and they offer different incentives. Different banks have access to different grant money, right? There's all kinds of layers, and that's why shopping around makes sense because they can somewhat set their own rate. Its decisions and policies can push mortgage rates up or down. To understand how this works, let's look at 3 key pieces of the Fed's playbook. Now we're honing in a little bit more specifically into the real estate industry now, guys. We got a big broad picture. We got the understanding of this. We went through, what the Fed is, how it got started, then how the Fed sets rates and how that affects other markets. Now we're getting into the more real estate specific area. The federal funds rate. Banks often lend money to each other overnight to meet their cash needs. The federal funds rate, also known as the effective federal funds rate, is an average of these rates, which informs lenders how much interest to charge on mortgages and other loans. It's important to note that the Fed doesn't set the EFFR itself. Instead, it sets a target interest rate range to which banks pay close attention. So they'll set like a broad range, like let's just say it's like 3 to 4% or whatever it might be, right? And that's what they're looking at. Banks are looking at to see what that number is, and then they correlate that into their own mortgage rate that they're going to be charging. When the Federal Reserve Open Market Committee, so we see how this is all kind of coming together. These terms now are making more sense, right? You understand these terms. Like when you hear Federal Reserve Open Market Committee, hopefully you now are understanding how that's structured and what that actually means. So when you hear news articles talking about different Fed met and they did this, you have a much better understanding now, hopefully. When the Federal Reserve Open Market Committee gathers at one of its 8 scheduled annual meetings, its members must decide whether to increase, decrease, or maintain the target range for the federal funds rate. That's what they're doing. We just looked at what that example looks like. Interest on reserve balances. To encourage banks to either increase or decrease their cash reserves. Remember, if they have a larger cash reserve, they're going to be more apt to loan money out because they're borrowing it at a lower rate. The Fed pays a risk-free overnight interest rate called the interest on reserve balances, the IORB. Okay? Since the Fed does control the IORB rates, it can use this rate to incentivize banks to either lend more money to other banks or keep more money in reserves, right? If the Fed wants to stimulate growth, it can reduce the rate paid on reserve balances. Because if a bank is making more money on the reserves, they're less apt to then loan the money out because they're gaining interest on that, right? They're making money on that. If the Fed lowers that amount, they're not making as much. So it's up to the bank to then figure out what they want to do with the reserves and they begin to loan it out, right? In response, banks will lend more money to each other and to consumers, reducing mortgage rates. See how this all kind of correlates now? If the Fed wants to slow economic growth, it can increase the rate, making it more attractive for banks to boost their reserves and earn risk-free interest from the Fed. When this happens, mortgage rates usually rise. Supply and demand. See how much control the Fed actually has? But this is absolutely the beautiful thing about this, though, is we could easily read a news article and immediately just put ourselves in the mind that, oh, the Fed, man, they control too much. They have way too much control of everything. This is a very scary thing. But then you got to understand the way it's actually structured. You've got governors, you've got a committee, and then outside of those committees, each one of those people have a board that they answer to. Do you realize how much input and discussion and stuff has to happen? It's not, and then it's separate from the actual senators and the president being able to put undue pressure on it. The terms that the governors have to serve inside of the Federal Reserve is 14 years. So again, there's this structure in place for protection. Is it perfect? By no means, no. But it is something that is the envy of the world, guys. And there's a reason why our Federal Reserve is the envy and why they control the majority of what the exports, imports look like, even for China, right? It's because the structure is in place to protect this. And we start looking at other countries and this is for people out there that think that America is not a great country. Guys, like we have some of the best policies, some of the best structure. It's not perfect. It's got all kinds of flaws in it. But we have a free, open market. The Federal Reserve actually helps us to be able to navigate that free market very effectively. It is not perfect. But when you take that model and you compare it against other banking industries around the world that have undue pressure by presidents and kings and dictators or whatever, we live in a country where we should be extremely thankful for what the Federal Reserve tries to do. And might fail, but the structure of it actually brings a whole lot of balance. And it does make us the envy of the world. It doesn't mean as if we get into the whole like personal aspect of things, and we're not talking about a hierarchy that we're better than anybody else. We're not talking about that, but we are talking about the simplistic nature of our economy and how it's governed and how it's managed. And it's a beautiful thing. It's something to be cherished about. It's something to be proud of. And it's also something to champion to the rest of the world to try to implement. Open market operations. In addition to the EFFR and the IORB, the Fed can also exert influence over interest rates through its open market operations. This strategy involves the Fed buying and selling securities on the open market. When the Fed wants to stimulate the economy, it can increase the amount of money in circulation by buying assets such as, this is where they start buying things, U.S. Treasuries and mortgage-backed securities, which are called MBSs, which leads to lower interest rates. That's a practice the Fed employed during the pandemic called quantitative easing. If the Fed wants to reduce the nation's money supply, it can sell assets. Okay, so if they want to reduce the nation's money supply, take the money out of the nation, it can sell the assets that it holds, leaving banks with less cash to loan out and increasing interest rates. They call that quantitative tightening. The Fed's MBS purchases also help bring mortgage rates down because the increased competition for mortgage assets made investors willing to accept lower yields. We can go on and on about this, but you kind of get the idea about how this operates now, hopefully. To kind of wrap this up, I'm going to read this summary on this article, and we're going to rest there because I just dumped off a whole lot of information. But hopefully you guys kind of got the structure on how this actually operates now. What happens to real estate when the Fed raises its target interest rates? Okay, so what happens when Fed raises? Mortgage rates usually increase, although not always in proportion to the Fed's moves. We talked about that. Competition among home buyers will likely decrease. Home price growth will typically slow down or stop. When the Fed lowers its target interest rate, mortgage rates usually decrease. Competition among home buyers will likely increase, and home prices will typically rise. Okay? So that's, if you were to take all this information, that now we have a better understanding, and then go straight into real estate, that summarizes that entire process and how it trickles down and affects us as real estate agents. Let me know if this has helped you have a better understanding in the way the Fed sets the rate in the economy. Let me know. Hopefully it's brought some insight you didn't have before. If not, maybe it solidified your understanding of it already. But I will say, in my entire experience in real estate, I've never heard somebody explain the Fed to me. I had to go out and research it myself and kind of learn how it all works and that kind of stuff. They don't teach it. Even the lenders coming in, talking about their loan programs, that kind of stuff, they just kind of skim over it. And I get it. They're limited time. I'm not knocking them at all. But I mean, I'm just saying though, understanding that how this all works, it makes us so much better to be able to help navigate the news cycles and the media and what they're saying and being able to articulate it correctly to our clients. And that kind of value can't be replaced by anything. It can't be replaced by anything. If you're an agent that has the most knowledge in your market in regards to your community, the way the banking system works, and everything about this, if you are diligent and you are a student of this practice, you will win hands down every single time over your competitors. You'll be the voice of reason. You'll be the advisor. That is the point. That is what we're trying to do. That is our value proposition. When everybody else out there is trying to redefine what our value proposition is, we can rest in knowing that it's in the knowledge that we have, being able to articulate it correctly to help navigate it with our clients. That's what we're here for. That is what we're here for. Let's see. I've already, you can't hear me? Did I lose my audio? Let me know if you guys can still hear me. I don't know. Can't hear me. I don't know why my audio went out. It shows that it's still coming through. Check. Okay, it's coming through on the other things. I'm not sure, Michelle, why you can't hear me. I don't know what happened. It looks like on my side everything looks fine. So I'm not sure what's going on. Oh, now you can hear me. Okay, good. Very good. That works. Ryham, hello to you as well. Thank you for being here. Let's see. I can probably go over one more. There's actually one I was going to tie into this. Let me see if this is yeah, I think I'm going to hold off on this one just because of time. I won't be able to. Yeah, I would love to go through another article, but this would be a deeper dive. I'm going to pass on it, guys. I'm sorry. It's already been an hour. I'd really, yeah. Okay. So hopefully you guys got some value out of this live stream. It was one note, one topic, but you know what? To be honest, I am super excited that I didn't have to talk about anything that we've been talking about. I'm not going to mention it. Like I'm going to be like the Harry Potter, the one we don't mention. Like it's like I think that's going to be my theme. I'm just not going to mention it. Okay, I think I did at the very beginning. Sorry about that. But it's been great not having to actually have a conversation about it at all and talk about something completely different. And also at the same time, like I love teaching. Like I like going through this kind of stuff and teaching. It's one of my biggest passions. I love doing this kind of stuff. So it's really good to kind of go in here and just do this. So hopefully you guys got some value out of this. So with all that being said, guys, this is the last live stream for this week. I will be back, Monday and Tuesday of next week. And then I will be, gone until I think it's June 11th. Be doing some, other stuff and it'd be a busy time this time of year. So I'll be tied up. So I won't be available during that time. So I won't be live streaming. So, but yeah, anyway, we'll be back Monday, 8:30 a.m. Eastern time where you're watching me now. So just come back and we'll do that. Do appreciate you guys greatly. My goal here is to provide something value back to you guys, help you guys to be able to succeed and all that kind of stuff. That is my goal. So hopefully I'm helping you guys do that. So with all that being said, guys, thank you guys for being here. Appreciate you guys greatly. That is your real estate brief for today. If you found this helpful, please consider hitting the like button to tell YouTube and TikTok and all those places you would like to see more of this type of content, and consider subscribing, following, all those type of things to join a community of real estate agents that are focused on building a business that is relationship focused first. I had a whole lot more I could be talking about, ran out of time, but that's okay. We'll see you Monday, 8:30 a.m. Eastern time. Until then, have a great day. Enjoy your weekend. Oh, wait, you know what? Pause. I will not be here Monday. I think that's Memorial Day. I might do a little short live stream or something. I don't know what we're doing that day. That just hit me. So I might not be here Monday. So if I'm not here, I'll see you Tuesday, 8:30 a.m. Eastern time. How's that? Yeah, happy Memorial Day weekend. Yeah, thanks, Michelle. Yeah, yeah. I totally. I was like, as soon as I said that, I was like, oh wait, no, I don't think I'll be there. Yes. Have a great weekend, everybody. You get an extra day. But if you're a real estate agent, I don't know what that actually means for you. So it's probably going to be an extremely busy weekend. You make a lot of money. Hopefully that's the case. All right, guys. Take care. Appreciate you guys greatly. Have a wonderful, wonderful day and weekend. Talk to you soon. And reach out to me anytime. DM me if I can be of any help to you guys. Take care.